Hello everybody, my name is Belinda and today I'm going to talk you through some of the basics of royalty withholding tax. This is the second of 3 videos. I've previously discussed interest withholding tax, and I'll also provide an overview of dividend withholding tax and foreign resident insurance tax in a subsequent video. Royalty withholding tax applies to payments of royalties by an Australian resident entity to a non-resident, or royalties that are paid to a non-resident by a non-resident who operates in Australia at or through a permanent establishment. Royalties are defined under our domestic law as any amount paid or credited, however described or computed, for the use of or the right to use copyright, patents, designs, or other similar property. It also includes use of scientific equipment, the supply of scientific, industrial, or commercial knowledge, or assistance that is ancillary to those. An amount which is consideration for the sale of an asset will not, however, constitute a royalty. This would be dealt with under either the CGT provisions or the capital allowances regime. A royalty also includes a payment made in respect of a total or partial forbearance of the use of any property or right indicated previously. Therefore, if an Australian entity makes a payment for the exclusive right to use an intangible asset in Australia, royalty withholding tax must be considered. The definition is really wide and will need to be considered at any time a payment is made to a non-resident in respect of the use of intangible assets. Where the recipient of the payment is based in a country to which Australia has entered into a double tax agreement with, often these agreements can provide some protection, and so should always be reviewed where royalty withholding tax may be an issue. Some of the treaties in Australia's network extend the definition of royalty to include the provision of technical services, where those services make available technical knowledge, skill, experience, or know-how, or consist of the development and transfer of a technical plan or design. The Mahindra decision, which was released in 2016, provided some additional guidance on what constitutes a royalty in these circumstances. So customisation of software, maintenance which requires a change to the source code, and enhancements that include coding upgrades will all constitute royalties. As a result of that decision, Australian companies making payments to any offshore providers of technical services should review their arrangements to ensure there are no withholding tax implications. In the context of software providers, earlier this year the ATO released Taxation Ruling 2021 D4, which sets out the ATO's view on where the various software distribution models constitute royalties. In that ruling, it takes the view that simple use of software, such as a single download to a computer for use, will not constitute a royalty. Any agreement which allows a taxpayer to adapt, modify, or copy the source code, however, will constitute a royalty. The ATO has changed its position in respect of software distributors, who it now considers has paid for the right to stand in the shoes of the software owner, with the consequence that payments by a distributor to an IP owner will now constitute a royalty. The key question in these cases is now whether the relevant distribution agreement has conferred exclusive rights of the copyright owner to the distributor. If it has, then a royalty will exist. And so this is a significant expansion of the ATO's previous position. Royalty withholding tax can also apply where payments are made for the use of marketing intangibles such as brand names and logos. The ATO discusses this in Taxpayer Alert 2018-2, and therefore where distributors are making payments to foreign entities for the right to distribute their products, care should be taken to determine whether any of the consideration paid is for the use of marketing intangibles. There is a question of apportionment of consideration, and unfortunately the ATO has provided limited guidance on that. It's important to note that many agreements have an additional gross-up clause for withholding taxes, and therefore it's important to determine at the outset whether royalty withholding tax may apply, as this is going to add an additional cost to the agreement. The standard rate of royalty withholding tax in Australia is 30%, although this is reduced under some of Australia's double tax agreements. The liability to withholding tax crystallises when either you make the royalty payments an amount is credited to the non-resident's account, or the amount is otherwise dealt with on behalf or at the direction of the non-resident entity. As with interest withholding tax, interest and penalties will accrue in relation to unpaid royalty withholding tax, and no deduction is available for a royalty payment until the withholding tax has been remitted to the ATO. The penalties for significant global entities are doubled. Again, all entities which pay royalties to a non-resident must lodge a non-resident annual withholding report with the ATO, and these reports cover the period 1 July to 30th of June, regardless of whether the paying entity has a substituted accounting period. The report must be lodged with the ATO by the 31st of October each year and includes not only royalties, but also withholding on dividends paid to non-residents, as well as interest. If you require any additional information in relation to royalty withholding tax or any withholding taxes, please contact your RSM advisor. Yours in tax, Belinda.